use before, and we dealt with when does investment property cease to be classified as investment property, or when does owner occupied property cease to become classified as investment property. There was an example in Gripping Cup example 6. This is the example that we ended on last time. So today we start with this slide where we're dealing with measurement of investment property due to a change of use. So what is the general rule? The general rule states that we need to apply the relevant IFRS up to the date of transfer, and then the IFRS relating to the reclassified asset. So what does that mean? Let us assume that we have a building which is owner occupied, and that building is treated as PPE. So up to the date of use, we'll treat it in terms of IAS 16, property, plant and equipment, and then we're going to transfer it to investment property, and we'll treat it in terms of IAS 40. So there are specific rules relating to how PPE will be measured before the change of use, and how it will be treated after the change of use when it's now treated as investment property. This is what we're going to look at today. Obviously, we can have a situation whereby we have an investment property whose use is changed to maybe changes to become inventories, or maybe changes to become owner occupied property. So there's a table here which deals with how would you deal with a transfer into or out of investment property. So if you look at the table, the first table we'll look at table 1. Okay, so this is the table that we're concentrating on. We have instances whereby proper owner-occupied property becomes investment property, or inventories may become investment properties. Alternatively, we have investment properties becoming owner-occupied property, or investment property becoming inventory. All right. So how would we treat this, or when is the transfer allowed? So for instance, when owner-occupied property becomes investment property, this transfer is allowed when at the end of owner occupation. So you cease using it, let's say using it as an administrative building or as a head office, and now you decide that you're going to use it as investment property, let's say to earn rentals. So you can go through this table, table 1. This is a summary of what we had in our last class on Thursday. Now, table 2 shows you how you will measure the transfer. How you'll measure the transfer. So you have 3 columns. The from column, so this one is showing you it transferring from PPE owner occupied property to investment property. And the last 2 columns here shows you how you will measure it in terms of investment property IAS 4. All right. So when you're using the cost model, this is actually quite straightforward. You will just use the carrying amount of the asset, all right? You will use the carrying amount of the asset. So if it was PPE, you would just use the carrying amount. If it was inventories, you would just use the carrying amount. However, if you're changing from PPE owner occupied property and your investment property is measured using the fair value model, then your investment property on the date of transfer would have to be measured at its fair value. All right, we will look at examples to deal with all of these, the changes of use. We'll look at examples from Gripping Up to illustrate exactly how you will account for this. Do you have any questions? Okay, it looks like there are no questions so far. All right, so what happens If there's a change of use and your investment property was classified using the cost model, all right? When using the cost model, it's actually quite straightforward. When the transfer takes place, there is not going to be a change in value when the transfer takes place because you're already using the cost model. All right. So for example, if your investment property is measured using the cost model, so that investment property, obviously it's costs less accumulated depreciation, you're going to transfer it to PPE, inventories, etc. at the carrying amount. So there's not going to be an adjustment. There's not going to be an adjustment there. This is also relevant when you change the change of uses from PPE, inventories or leases, and you change that use to investment property, and you decide to classify your investment property, or you decide to measure your investment property using the cost model. Then you're just going to look at what was the carrying amount of those particular assets on the date of transfer to investment property. So there's no difference there in the values. The trick comes in when you're classifying your investment property as using the fair value model. When you classify the investment property using the fair value model and it has changed from PPE to become investment property, there will be a difference in the measurement. All right, there will be a difference in the measurement. And what will happen? So let us assume that you have PPE, which you treat in terms of IAS 16, and the PPE is accounted for using the cost model. But then you want to transfer to investment property, and you've decided to measure your investment property using the fair value model. What needs to happen? In that instance, you will account for PPE using the cost model up to the date of change. And then at the date of change of use, when that PPE becomes investment property, you will then have to revalue the PPE to its fair value. All right, you'll have to revalue the PPE to its fair value, even though you were using the cost model to account for the PPE. All right, so you'll have to remeasure it to its fair value and then transfer to your investment property. And in that instance, you're going to have a revaluation gain or loss. And in that instance, that revaluation gain or loss on the date of transfer is treated in terms of IAS 16. How will we, how can we illustrate this? Let us look at this example. This is example 7 in gripping up. That's on page 528. I think that's from the 2020 edition. Okay. So let us go and look at the required first. The required tells us to show the journals relating to Fantastic's head office for the year ended 31 December 2018. So when it tells us to show the journals, they haven't specified which journals. They haven't said the journals relating to the transfer. So it means we have to show all the journals for that year. All right. So when you're reading a question, just look properly at what the required is. So in this instance, if we're showing all the journals, we might have to look at even things, consider items such as depreciation. All right, so let us look at this example. Fantastic Limited had its head office located in Derast, South Africa. During a landslide on 30 June 2018, a building nearby, which it owned, was rented to Sadly was destroyed. So it owned a building which was rented to Sadly, and that building was destroyed. As Sadly Limited was a valued tenant, Fantastic Limited decided to move its own head office to another underutilized building nearby, which was currently also used for administrative purposes. and to lease this original head office to Sadly Limited as a replacement. The move is effective from 30 June 2018. All right, so just to summarize it, we have this company, which is Fantastic Limited. It owns a building, all right, and it has another building which is destroyed, and that other building was rented to Sadly Limited. So what Fantastic Limited decides to do is that they're going to move out of their own building, which they're using as a head office, and they're going to move to another building that they have, so that Sadly can now move into the building that they were using as a head office. All right. So what is happening there is that a building that was used as a head office now becomes investment property because it's going to be rented out to Sadly Limited. And then we have other information. The head office was purchased on 1st of January 2018 for 500,000. The total useful life was 5 years. The fair value of the building was 520,000 on 30 June 2018, and it was 490. Sorry, what happened? And it was 490,000 on 31 December 2018. You have other important information, this information that you need. The cost model is used to measure its property, plant, and equipment, and the fair value model is used to measure its investment property. All right, so we know that we must account for property, plants, and equipment using the cost model, and we will account for investment property using the fair value model. All right, so there's quite a lot of information. If you look at the required again, show the journals relating to Fantastic's head office for the year ended 31 December 2018. So we have to show all the journals. We have to show all the journals. All right, not just the journals on the date of transfer. Not just the journals on the date of transfer. So let us look at this. What is the first journal that you will account for? Can anyone tell me what is the first journal that you'll account for? What is the first journal that you'll account for? Go ahead. The first journal that you'll account for, what is that? What is that first journal? Do you account for any journal on the 1st of January 2018? Okay, so the first journal that you're going to account for, since it told us to account for all journals, you have to account for the purchase of the property, plant, and equipment on 1st of January 2018. All right, and that I can see in the chat. I wasn't looking at the chat, but now I can see in the chat, someone has given the journal, debit office building, credit bank. Okay, one important thing that you need to note, you should specify whether the office building is property, plant, and equipment or whether it is investment property. If you do not specify, I do not know whether that office building is classified as investment property or whether that office building is classified as property, plant, and equipment. So the first journal that we're going to account for is the purchase of the building on 1st of January 2018. All right. So you debit your property, plant, and equipment. Okay. So I'm just going to skip the comment. We're looking at the what we'll do on 1st of January 2018. Debit property, plant, and equipment, 500,000. credit your bank or liability 500,000. We don't know whether this building was paid for in cash, so that's why we're using either a bank or your creditor that you're going to account for. So this is the first journal entry. This is straightforward. But one thing that is important is that we have there, we show that it's PPE. So debit PPE, office building. You don't have to have this where it says carrying amount. You should you can actually leave that out. All right, uh, because obviously we know the figures that you're going to put. So debit your PPE, office building. Okay, and then you're going to credit your bank, or if it was paid for at a later date, then you will credit your liability or your creditor. All right, so that is the first journal that we are going to account for. Let us go to the next one. Let us go back to the question. All right. Then we're given fair values of this building. The fair value of the head office building was 520,000 on the 30th of June, and we're given another fair value of 490,000 on the 31st of December. All right. So there was a transfer that that took place. And this transfer took place on the 30th of June, 2018. So the transfer from being owner occupied property to investment property took place on the 30th of June, 2018. So since by that time, 30th of June 2018, it's still accounted for as PPE, we have to account for it in terms of IAS 16, property, plant and equipment. So we have to depreciate this property, plant and equipment up to the 30th of June 2018. So can you provide me the journal entry to account for depreciation on 30th of June 2018? What is the journal entry to account for the depreciation on 30 June 2018? The journal entry to account for depreciation on 30 June 2018. Can you provide it for me? I'm waiting for you. Okay, so PPE was in our test. So this building was bought on 1st of January 2018. We're told that it has a useful life of 5 years. So we assume that we're going to depreciate this over 5 years over its useful life. We're accounting for this property using the cost model. So we know that the cost model says the cost minus accumulated depreciation minus accumulated impairment losses. So in this instance, we just take the 500,000, divide that by 5 years, you'll get an amount of depreciation of 100,000 per annum. But this property was only depreciated up to 30 June 2018. That is the date of transfer. So we only have to depreciate it up to 30 June 2018. So our depreciation for 6 months, we will take the 100,000 times 6 over 12. We'll arrive at an amount of 50,000. So 50,000 is our depreciation for that year. All right, so we account for depreciation. You know the depreciation journal. Debit your depreciation, 50,000. And then here we're going to credit our accumulated depreciation. All right, why are we crediting PPE office building here instead of accumulated depreciation. I just want to show you, I want to go to this question in gripping up. So I will share the gripping up page. I'll share gripping up. Okay. This is the gripping up. We're looking at this example. This example says, show the journals. Okay, so this is where I'm reading from the required part. Show the journals relating to Fantastic head office for the year ended 31 December 2025. You may use a single account to record the movements in the head office's carrying amount, right? In other words, do not use a cost and accumulated depreciation account. So this is just the required in the question. But in the question that was given in the slides, that required didn't, our required didn't mention that. All right, let me just share let me share the slides once again. Okay, here at the slides. So in this question just says show the journals. It didn't tell us to use one account. All right. So because it didn't tell us to use one account here, you can, the account that you would use is accumulated depreciation office building, and the amount is 50,000. All right, the amount for this accumulated depreciation would be 50,000. But if you're going to look at your book, then you just need to use the instructions whereby you just credit your PPE office building instead of your accumulated depreciation account. All right, because that was the required. So it's very important for you to read the required very carefully to understand what is the requirement, and in order for you to gain all your marks. Okay, so now we've accounted for the building in terms of IAS 16, property, plant, and equipment. Then we move on. We move on after we have accounted for the building in terms of IAS 16, property, plant, and equipment. There's a change of use that occurs. The building, Fantastic Limited, moves out of the building, and Sadly Limited moves into the building. Fantastic Limited begins to rent out the building to Sadly Limited. All right. So that tells us that the building changes from owner-occupied property, and the building becomes investment property. Now, one important figure that is appropriate here is the fair value on the date of transfer. And why is the fair value important? Because the information tells us that Fantastic Limited uses the fair value model to measure its investment property. It uses the fair value model to measure its investment property. So what does IAS 40 tell us? What does the standard tell us? It tells us if the fair value model is being used to account for investment property, that the building needs to be transferred at its fair value. All right. However, in this instance, Fantastic Limited uses the cost model to measure its fair value. I mean, to measure its property, plant, and equipment. It uses the cost model to measure its property, plant, and equipment. So in this instance, the standard says that IAS 40 states that we have to revalue the PPE to its fair value, even though the cost model was used to account for PPE. So we have to revalue the PPE to its fair value, and then only then do we do the transfer into investment. At 30th of June 2018, What is the carrying amount of the building? What is the carrying amount of the building? Can anyone tell me what is the carrying amount of the building at 30 June? Remember, carrying amount is your cost minus accumulated depreciation. What is the carrying amount on 30 June 2018? Okay, go ahead, Matthias. Go ahead.
It's 450.
450,000. Exactly,
Yes,
450,000, which is 500,000 minus your 50,000 depreciation. The carrying amount is 450. However, we're given a fair value of 520,000. So the building has to be revalued to 520,000. So how are you going to do the revaluation? Can you provide me the journal entry to account for the revaluation of the building on 30 June 2018? The journal entry to account for the revaluation? Anyone? You can also type in the chat if you're in the library or or somewhere where you cannot speak.
You debit the office building with 70,000 and credit the revaluation surplus with 70,000.
Exactly, and revaluation surplus is what type of account, or how would you classify the revaluation surplus?
Other comprehensive income.
Or other comprehensive income.
Other comprehensive income, exactly, that is correct. So let us look at our journal entry. Debit PPE office building. So remember, it's still PPE even before we transfer it, and then we credit our revaluation surplus. All right, the revaluation surplus, other comprehensive income, and the amount is 70,000. All right, the amount is 70,000. So what is important here is that the building is still classified as PPE on 30th of June. This is immediately before the transfer. All right. So your general narration can just be revaluation of building on 30th of June 2018 before transfer to investment property. Or you can just say revaluation of office building on 30th of June 2018. So now we do the transfer. And since the building is going to be measured at its value in terms of IAS 40, we're going to do the transfer of the building at 520,000, its fair value. Debit your investment property, office building. So here you don't have to write a fair value. This is just for understanding. All right. Debit your office building at its fair value and credit your PPE office building 520,000. So you see, it's very important for you to indicate we are crediting the PPE, the office building, and we're debiting the investment property office building. All right. Are there any questions? Okay, it looks like there are no questions. Let us proceed. There's one more journal entry. And where does that journal entry, what does that relate to? Let us go back to a question. The question states, show the journals relating to Fantastic's head office for the year ended 31 June. So this transfer was made on, the transfer was made on 30th of June, but the year ends on 31 June. So we have to deal with the journal entry to account for the value of the building on 30th of June, on 30th of December, sorry, 31st of December 2018. And we're given information. On 30th of December 2018, the building has a fair value of 490,000. All right. So the investment property has actually decreased in value because it was valued at 520,000 on 30th of June, but now on 31 December, it is now valued on as 490,000. So it has decreased in value by 30,000. So what is the journal entry that we will write? What is the journal entry that we'll make to account for the decrease in fair value? Anyone? The journal entry that we'll make to account for the decrease in fair value.
Reverse revaluation surplus with 30,000.
And then?
And then credit office building 30,000.
Okay, and then you credit your office building 30,000. Okay. The office building that you're going to credit, is it classified as investment property or is it classified as PPE?
PPE.
Okay, so this is where now we have to ask ourselves, what has happened? We had this building that we initially classified as PPE, but then it has changed its use, and now we classify this building as investment property. And since it has changed its use and it has become investment property, we have to treat it in terms of IAS 40 investment property. All right, we have to treat it in terms of IAS 40 investment property. Okay, just hold on quickly. I just need to. All right. Let me go back. So when you credited the revaluation surplus, when you credited the evaluation surplus, that would have been correct if the building was treated under IAS 16 property, plant and equipment. But because the building is now treated in terms of IAS 40 investment property, then we have to look at what the treatment says. So IAS 40 investment property does not account for any revaluation surpluses or any revaluation expenses. It only accounts for fair value adjustments. All right, so we'll call it a fair value adjustment on investment property. And all fair value adjustments are accounted for in profit or loss, and they do not go to other comprehensive income. So in this instance, we actually have a loss on your fair value adjustment. All right. So we have a loss on your fair value adjustment. This goes to your statement of profit or loss, 30,000, and we credit our investment property, 30,000. All right. And our narration is just to is a remeasurement of investment property to the fair value at year end. So this is very important. The revaluation surplus that we had, let me go back to that revaluation surplus. Revaluation surplus that we had when we classified the building as a property, plant and equipment, it will still remain under OCI. We are not going to change it once we have we're not going to reduce it when we have a readjustment to fair value. We're just going to call it an adjustment to fair value and take it to your profit or loss. The only time this revaluation surplus will ever be touched again, even though the building is treated under investment property, is when the building is actually disposed. So we'll account for it when we're accounting for profit or loss on disposal, but otherwise it just remains as a revaluation surplus, and there's no adjustment to it when we have future revaluations because of fair value adjustments. All right. And that is because the fair value adjustments are now treated in terms of IAS 40, investment property, and not IAS 16, property, plant, and equipment. So this is just where the trick comes in. Okay, is that clear? Yeah, I think that is clear. I think that one is clear. So let us move on. Okay. Now we have a new scenario where we have a change in use. All right. And in this instance, in this example, our property is classified as inventories. So this company has a business that is involved in buying and selling buildings, and it changes it and it becomes investment property. So the building will now be used to earn rentals or for capital appreciation. And so what does the standard tell us? We have to measure those buildings which are classified as inventories in terms of IS2, which is inventories up to the date of transfer. And then we're going to transfer the inventory at its carrying amount to investment property. And once it's investment property, we are going to remeasure the buildings to their fair value. All right. So this is different from the cost model. It's different from when we changed the classification of property, plant, and equipment to investment property. Because what did we do? We first measured the property, plant, and equipment in terms of its carrying amount, and then we did a revaluation surplus, or in the previous example. So we revalued the property and then we transferred it to investment property at its fair value. All right. But now in this instance, we have to transfer the property at its carrying amount, right? We transfer it to its carrying amount, and then we are going to remeasure the investment property to its fair value. All right. So the remeasurement is done after the transfer. However, in the previous example, the remeasurement was done before the transfer. Okay. Can anyone tell me what is the rule of inventories IS2? How do we measure inventories in terms of IS2? You did inventories in Financial Accounting 101.
Okay.
Yes, go ahead.
At net realizable very old at low cost.
Yes, at the lower of cost or net realizable value. So if the net realizable value is higher than its cost price, then we just have to use the cost price. If the net realizable value is lower than its cost price, then we have to actually account for a loss, all right, an impairment loss. We'll call it an impairment loss, and we're going to measure it downwards. All right. So actually, you won't call it an impairment loss. It's a loss on write down of inventory. It's a loss on write down of inventories, but the equivalent would be an impairment loss when looking at PPE. All right. So the rule for inventories are measured at the lower of cost and net realizable value. So this is the next example in gripping up. We'll just read the required. Again, I always start with the required just so that we know what we're expected to do. Provide the journals for Chess Limited's year end 31 December 2018. All right, so we need to provide the journal entries for 2018. So it means we're going to account for all the journal entries for that year. All right. Chess Limited purchases a building on 1st of January 2018 for 250,000 that it intended to sell in the ordinary course of business. So this sentence is very important, that it intended to sell. If the intention is to sell, then obviously that building will be classified as inventories. Then Player Limited asks Chess Limited to lease the building to them for a period of time. An operating lease agreement was then entered into and became effective from 1st of March 2018. On 1st of March 2018, the building's fair value was 300,000 and the net realizable value was 290,000. On 31 December 2018, the building's fair value had grown to 340,000. Chase Limited used the fair value model to account for its investment properties. All right. So it's a straightforward question. We're transferring inventory to investment property. What is the first journal entry that we account for in this question? As part of the required, what is the first journal entry that we're going to account for?
Purchase of the building.
Purchase of the building. All right. So what is the journal entry? What is the journal entry then?
I think we debit inventory and then we credit bank.
Debit inventory, credit bank. Exactly. All right. Debit inventory, building, 250,000, credit your bank or your liability. It didn't, we were not told whether this building was paid for. So you can either credit your bank or you credit your liability. Okay. Now on 1st of March 2018, when an operating lease agreement was entered into, so you're going to have the company Chess Limited, Player Limited wanted to lease the building, so it was leased to them. So they entered into a lease agreement to rent out the building. All right, so Chess is renting out the building to Player. Now on 1st of March, there's a change of use. The inventory now becomes investment property because the building is no longer held for sale in the ordinary course of building of business, but now it is held for rentals, and you're going to get rentals each and every month from Player Limited. Okay, so we have to measure it in terms of IAS 2 up to the date of transfer, and IAS 2 states that inventory is measured at the lower of cost or the net realizable value. So on 1st of March, on 1st of March 2018, the net realizable value was 290,000. However, the cost price of this building was 250,000. So at what value will that inventory be carried at on 1st of March? At what value will the inventory be carried at on 1st of March?
At low cost.
At the cost price, because the cost price is the lower amount. All right, so the value that it would be carried at in this instance is 250,000. All right, so it doesn't change anything. The value of the building stays the same. We cannot value it at its net realizable value. However, if the net realizable value was 210,000, then we would have had to measure the inventory at its 250,000. and 10,000. So then there'll be a write down to the net realizable value. But in this instance, we're going to leave it at its same amount at the cost price. Then we can immediately do the transfer to investment property. So the building changes, we debit our investment property building and we credit our inventory. Okay. So your building, the narration, you can just say recognizing inventory that is transferred to investment property, recognizing inventory transferred to investment property. So it's transferred at its cost price of 250,000. However, we are not done. All right. So we are given a fair value of the building. We are told that the fair value of the building is 300,000 on 1st of March. So now that the building is in investment property, we are going to have to measure it at its fair value on 1st of March. And the reason we're going to use the fair value is because Chess Limited uses the fair value model to account for its investment properties. If Chess Limited had been using the cost model, we wouldn't have an extra journal entry to account for any changes in the fair value. We would just leave it at 250,000. However, since Chess Limited uses the fair value model, we'll have to revalue this building to its fair value of 300,000. So we debit our investment property 50,000, credit our fair value adjustment 50,000. How do we get the 50,000? The building had a cost price of 300,000, but now on the 1st of March, the date of transfer, it has a fair value of 300,000. So it means the value of the building has grown by 50,000. So we debit our investment property 50,000 and we credit our fair value adjustment 50,000. And then lastly, the last journal entry that we account for is the journal. The last journal entry that we account for, sorry, there's something wrong here. The last journal entry that we account for is the journal entry on 31 December. On 31 December, we have an additional change whereby the fair value has increased again. It has increased now from 300,000 to 340,000. So we have to deal with our fair value adjustment. So we debit our investment property to increase it by 40,000, credit our fair value adjustment of investment property to account for the remeasurement of investment property at year end 31 December. All right. Are there any questions? Okay. So it seems there are no questions. You can go through the example 8. So go through these examples that we have done already, and then go through again the example in gripping up, where now you deal with the change from investment property to PPE, where you change from investment property to PPE. So tomorrow we'll start with derecognition and presentation and disclosure. We'll start with derecognition and presentation and disclosure. I will post an activity for you to do that we can actually go through tomorrow. Okay, I just need to go through the chat and see if there are any questions. Okay, in the chat, someone asked, what are the procedures for consultation? You can just send me an email message or a message on Teams whereby you request for a consultation. Just let me know the time that you'd like to make the consultation, and then we take it from there. So an email or a message on Teams for consultation. All right, consultation is very important, especially where you do not understand. But what I'd advise you to do first, don't don't come to consultation with me if you haven't gone through your work, because I will ask you, what have you done? So the first thing is to read your notes, consult with your peers, all right, so your classmates, and then if everything fails, then you can come for consultation, and I would be happy to help you. All right. Do you have any other questions or queries?